Hello traders, and welcome back to the Lucro channel. Understanding and accurately mapping the market structure is the foundation every trader needs to build consistent profitability. Many traders struggle, not because their strategies are bad, but because they fail to read structure correctly, and that turns their trading reactive instead of strategic. In this video, you'll discover the essential principles and practical techniques of market structure mapping that will help you anticipate price movements with greater clarity and confidence. If this is the kind of knowledge you value, hit the like button, subscribe to the channel, and stay tuned for more insights to elevate your trading journey. Let's get started with market structure. The driving forces behind price movement can be simplified into two essential dynamics that constantly shape the market. The first is trending, which includes both uptrends and downtrends. And the second is the consolidation phase, which you might recognize as a ranging or choppy market. Think of it as a continuous cycle, where price flows naturally between downtrends, uptrends, and consolidation periods. These consolidations act as areas of liquidity building and order accumulation by institutional players. In most cases, price needs to pause and consolidate before transitioning from an uptrend to a downtrend, or vice versa, forming the rhythm that defines every market movement. The very first question to ask when you open your charts is simple yet powerful. Is the market trending upward, trending downward, or moving sideways in a consolidation phase? To build a solid foundation, we'll start with a basic introduction to market structures, then move gradually into the key elements of advanced structure analysis that every trader should master. Let's begin by examining what we can call an ideal uptrend structure. I use the word ideal intentionally, because such perfect formations are rare in live market conditions. Price rarely behaves in a perfectly symmetrical or predictable pattern. However, studying this ideal form helps us develop a clearer understanding of how an uptrend is designed to move, before we move on to more realistic and complex structures that occur frequently in real trading environments. In a typical uptrend, price consistently forms a sequence of higher highs and higher lows. Each bullish wave breaks above the previous high while protecting the prior low. The uptrend remains valid as long as these major lows hold. Once price breaks below a major low, the structure shifts and the uptrend effectively ends. For instance, to keep an uptrend intact, price must not violate its most recent major low. Conversely, whenever price breaks a significant high to the upside, it generates a break of structure and often creates a demand zone linked to that bullish move. Accurately identifying these major highs and lows is essential. They serve as the map that allows us to spot potential trend continuations or reversals with precision. Without this clarity, traders can easily be misled by noise and end up trading against the dominant direction of the market. The same logic applies in the opposite scenario, the downtrend. In a downtrend, price forms a continuous pattern of lower lows and lower highs. Here, the market tends to break previous lows while holding on to the preceding highs, reflecting sustained selling pressure and the continuation of bearish momentum. Now let's move deeper into the details of what we call the realistic market structure. This version represents the practical uptrend formation that traders encounter, more often in live markets. It is less perfect than the theoretical model, yet far more valuable, because it reflects how price truly behaves under real trading conditions. Imagine a situation where price breaks previous highs to the upside. At that point, a crucial question arises. How can we accurately identify the valid major highs and lows that define this structure? To answer this, look to the left-hand side of the chart. You'll notice that price first moved upward before beginning a retracement. The highest point reached before that retracement began is considered the major high. In contrast, the lowest point of the bullish wave that launched the move upward eventually producing the break of structure and forming a new high, is defined as the major low. Together, these 2 points form the major external structure of the trend. Any price movement that occurs between these 2 boundaries is referred to as internal structure. When price breaks above the major high, creating a new BOS, it confirms a trend continuation and reinforces the bullish momentum. On the other hand, if price falls below the major low, that action serves as a clear signal of potential trend reversal. The internal fluctuations of price within these external boundaries are less significant, as long as the market remains above the most recent major low. As long as this condition holds, we continue to view the market as bullish and expect upward continuation until proven otherwise. Now that we've identified the most recent major external structures, these points clearly define our current area of interest and the active trading range in the market. As we can observe, price has entered a retracement phase, generating a series of internal structures, most of which display short-term bearish behavior. After this internal pullback, the market forms a bullish realignment and then breaks the recent major high to the upside, creating a new major high and a new major low. This newly formed major low corresponds to the internal low located at the extreme. It is classified as a major low because it represents the final low formed before price began the bullish movement that produced the break of structure. You might wonder why the other nearby low isn't considered the major one. The reason is simple. The extreme low is the lowest point reached before the upward reversal began, making it the true structural foundation of that bullish leg. This specific low holds significant importance as it marks the origin of the impulse that triggered both the upward move and the eventual BOS. Now, let's look at the bearish scenario, which mirrors the same logic in reverse. The structure begins with the formation of a bearish wave, leading to a break of structure to the downside. Here, we also identify a major low representing the lowest point reached after the BOS, as well as a major high marking the upper boundary of this external structure. These 2 levels, the major high and the major low, together form our external framework, while every smaller fluctuation or internal move between them is considered part of the internal structure. If price breaks the major low to the downside, creating a new BOS, that confirms a continuation of the bearish trend, just like we see in this example. Conversely, if price rises above the major high, we interpret it as a potential trend reversal signal. Put simply, the nature of internal price action within these external boundaries doesn't change the overall picture, as long as price stays below the most recent major high, which keeps the market in a bearish condition. As the retracement unfolds, price forms a sequence of internal highs and lows within our trading range. Eventually, it pushes downward again and breaks the recent major low, confirming another bearish break of structure. At this point, the internal high positioned at the extreme transforms into our new major high, because it is the highest internal point created before price initiated a strong bearish impulse that led to this BOS. Following this movement, price retraces once again, forming a new major low, and after generating multiple internal structures, it continues its downward momentum, producing a consistent sequence of lower lows and lower highs, a clear sign of sustained bearish control. Now we move into one of the most crucial aspects of market structure, the break of structure, commonly referred to as BOS. You've probably come across the term BOS in trading tutorials, market structure videos, or technical handbooks. In most of these, a bullish BOS is described simply as a case where price breaks a previous high to the upside. While that basic definition is not incorrect, it's incomplete. In practice, There are specific rules and validation criteria that must be met before we can confirm a true and valid break of structure. So, let's now look closely at those key points and rules. A valid break of structure occurs when price breaks and closes above the most recent higher high, and, importantly, this break must be confirmed by the body of a candle, not just a wick. This rule applies even if price immediately retraces downward after the breakout. When such a valid BOS happens, the market creates a new major high and major low, effectively establishing a new trading range. If after this new range is established, price then breaks the newly formed major low to the downside, it suggests a potential trend reversal. This shift signals that the market is no longer maintaining its bullish structure, and we identify this as a change of character, a clear warning that the direction of the trend may be turning. However, not every apparent breakout qualifies as a BOS. For example, if price only pierces the previous high with a long wick or shadow, but the candle body closes back below that high, and the next candle's wick does not exceed the previous one, then this move does not represent a valid break of structure. In such a case, the move is treated as an internal fluctuation within the existing range, not a genuine breakout. Therefore, to properly identify a true reversal or a legitimate change of character, we must patiently wait for price to break the major low located at the extreme, rather than reacting to the break of a smaller internal high. This disciplined distinction between valid and invalid BOS signals is what separates structured analysis from emotional trading decisions. Now, let's consider another important scenario. Suppose the price breaks the most recent higher high with a wick, and the body of that first candle closes below the high's range. Then, the next candle's wick exceeds the previous wick. In this situation, we can classify it as a valid bullish break of structure. When this happens, a new major high and major low are formed, defining our updated trading range. Within this range, the internal price action, the smaller fluctuations or short-term pullbacks, doesn't hold structural significance. As long as the price remains above the newly established major low, we continue to consider the market bullish, with the trend still intact. Only when price breaks this newly formed low to the downside can we confirm a valid trend reversal or a change of character pattern, signaling that the bullish momentum may be ending. Now let's briefly shift focus to the bearish scenario, which mirrors the same logic but in reverse. In a bearish market structure, for a break of structure to be valid, the price must break and close below the most recent lower low. And this confirmation must come from the body of a candle, not just a wick. However, if price breaks that low and then moves upward to break the newly created major high, this indicates a trend reversal, a sign that sellers have lost control and that buyers are regaining strength. On the other hand, if price breaks the recent lower low only with a long wick or shadow, but the body of the candle closes above the range of that low, and the next candle's wick does not exceed the previous wick, this move cannot be considered a valid bearish BOS. To confirm a true bearish break of structure, we must wait for a candle to close below the range of the low with its body, ensuring that the breakout reflects real selling pressure and not just temporary volatility. This clear distinction between wick-based false breaks and body-confirmed structural breaks helps traders avoid premature entries and stay aligned with the true market direction. On the other hand, if the next candle's wick surpasses the first candle's wick and its body closes above the range of the low, then we can confidently classify it as a valid break of structure. After this confirmation, we must update our major low and major high to reflect the new market dynamics. As long as price remains below the newly established major high, the market should still be viewed as bearish. only when price breaks this newly formed major high to the upside can we treat it as a valid trend reversal or a major change of character. Having explored several types and scenarios of BOS patterns, and now possessing a clear understanding of what defines a valid break, we can move forward to another critical concept in market structure mapping, the change of character. To correctly identify a valid change of character, the first step is to determine the overall market direction, whether the market is currently in an uptrend or a downtrend. Once that's established, the next step is to mark all valid BOS points on your price chart. Let's take the bullish scenario as an example. Imagine price forming a series of valid breaks of structure to the upside. The low and high linked to the first valid bullish BOS define our major structural boundaries. As mentioned earlier, any movement that develops within these two structures is considered internal price action. Now, change of character patterns can be divided into two categories, minor and major. Each time price breaks an internal low, it produces a minor change of character. However, it's essential to understand that a minor change of character alone does not indicate a full structural shift or a reversal in market direction. It merely shows temporary weakness within the broader trend. This brings us to a very common mistake that many novice traders make. Traders who fail to correctly identify the true market structure often misinterpret a minor change of character as a complete trend reversal. They see a single internal low being broken and assume that the bullish phase has ended, prompting them to enter short positions prematurely. Typically, they place their stop loss just above the internal high, which makes them vulnerable to being stopped out as the market resumes its upward movement. However, contrary to their expectations, the price, after a brief retracement, reversed upward and continued its bullish movement. This upward push resulted in triggering the stop losses of traders who had entered premature short positions. Many of these traders failed to understand why their stops were hit, and unfortunately, they tend to repeat the same mistake again and again. What they overlooked is a critical detail. Price never broke the major low that was needed to confirm a true market structure shift. They shouldn't have entered short positions until the market broke the last major low to the downside. Their so-called change of character was actually invalid, since price was merely completing a retracement phase before resuming its primary bullish direction. To identify a valid market structure shift, a trader must wait patiently for price to create a major change of character by breaking and closing below the last major low, the one that initiated the previous bullish impulse leading to the break of structure. Furthermore, it's essential to always remember this rule. In a bullish scenario, a change of character is considered valid only when price breaks and closes below the last major low with the body of a candle. If price merely pierces the structure with a long wick or shadow, and the body of the candle closes back within the previous range, then this change of character is invalid and cannot be interpreted as a structural reversal. The same concept applies to the bearish scenario. For a valid change of character, price must break and close above the recent major high with the body of a candle. A simple wick or shadow is not enough to confirm a true shift in trend. Before we wrap up this video, let's take it one step further. Up next, we'll play the introduction of our video, 10 Truths Top Traders and Investors Never Ignore, a segment that reveals what truly separates consistency from chaos in trading. We strongly recommend that every trader watches the full video, as it brings together the insights and mindset shared by some of the greatest traders and investors of all time. Check it out.
When we look at the results of traders, their profitability, it turns out that only a modest fraction of the success comes from the actual ideas that they're trading. The ideas are important, but they're not all important. Once you have the idea, you still have to structure that idea as a good risk-reward proposition to turn it into a trade. And that's a very detailed area of exploration. So if I have an idea that the global economy is growing, that there's going to be economic expansion overseas, that will carry over to certain international companies in the US, great, that's a worthwhile idea, but where do I buy? Where would I sell? How would I structure that trade? Would I think about using options and limiting the amount of premium that I dedicate to the idea? Might I structure it as a spread trade or a relative value trade? I'll buy this industry and sell another industry against it. There's so many different ways of structuring an idea, so many different ways of timing and sizing an idea. Those are the mechanics of trading, and they account for a surprisingly large degree of success or failure of traders.
That's where real trading begins. Not in the idea itself, but in how you bring it to life. Every great trader has learned this. Success comes from structure, repetition, and emotional control. In today's video, we'll explore 10 timeless truths that top traders and investors never ignore. Insights that reveal what really separates consistency from chaos. You'll hear from some of the most respected minds in the trading world: Brett Steenbarger, Francis Hunt, Tom Hugard, Alexander Elder, Howard Marks, Darren J. Miller, David Paul, Warren Buffett, Phil Gottaker, and Larry Williams. Each of them brings a different angle, from psychology and mindset to patience, risk, and survival. But together, they form a complete picture of what it truly takes to last in the markets. And that's exactly the mission of CommLucro. Our goal is to give traders the knowledge they need to make better decisions in the market. Every video, every course, and every piece of content we share is built with that in mind. Clear, practical information that helps you grow step by step as a trader. On this channel, you'll also find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading is not just about the charts, it's also about how you think and how you manage risk. We also bring lessons and insights from world-class traders and coaches like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others who have shaped the way we understand the markets. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the CommLucro Trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.